I have a feeling that gold and silver are going to surprise on the upside because this breakout is quite significant. And yeah, so I mean, looking at the technical picture, if you measure like the move from the beginning of the year to April in gold and you extrapolate it from the breakout, it gives you 4,300. But it could be even more in the next 4 to 5 months, I would say. I think Goldman Sachs has come out and they said they could see 5,000 if the market loses confidence in the Fed. So anything's possible.
I think gold can get to 5,000 or more. And with that, I think silver will get and print at least at a triple-digit number. So I still think there's a lot of upside left for it. And I still look at myself as we record this and saying, is PeterGrandich really saying that about silver? But he is.
Gold and silver are sending a powerful message. The breakout from months of consolidation is not a mere technical move. It signals the world's shifting confidence away from fiat currencies and toward tangible reserves. On the charts, projections suggest gold could surge past $4,300 in the coming months, with some estimates from major institutions envisioning $5,000 or more if the Federal Reserve loses credibility. Silver, often the more explosive of the two, is already showing leadership and could print in triple digits. Beneath the surface, the forces driving this move are both structural and geopolitical: slowing Western economies, ballooning debt burdens, and the accelerating momentum of de-dollarization as BRICS nations tighten cooperation. MarioInnecco and PeterGrandich discuss how revaluation talk within the Federal Reserve and historic parallels to the 1970s highlight the fragility of the current system. The potential for a reset through gold revaluation exposes the weakness of the fiat experiment, while global alliances are increasingly building around hard assets as neutral, borderless reserves. The implications are historic, placing gold and silver at the heart of the world's financial future. Before we dive into the sharp insights from their latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
I think there's a good chance because even the Treasury, well, actually the Fed, their accounting manual earlier in May, they wrote about that. And in the beginning of August, there's an essay written by an economist for the board of the Federal Reserve talking exactly about that. So they are thinking about it. What it will do to the price is put a floor at the level that they choose to revalue it to. Right now, it's at $42.22. Even if they were just to revalue it to $3,500, which is where we are right now in the spot price, that will put a rocket up even more, rocket up the gold price even more, because in 1972, they revalued from 35 to 38, and then the market just kept going up. And then they revalued again in 73 to the level that we have now. And gold took off and went to like 200 by the end of, I think, 1974. Well, I think the reason they haven't revalued it is because they want to keep gold out of the public conscience. Because if they revalue, people are going to realize that the emperor dollar has no clothes, and that gold is the ultimate reserve asset. So if you keep it there, it means you don't need it, right? It's just it's just pet rock sitting there, and it's useless. But if they revalue it, it's an admission that the fiat experiment has failed, and it was failing back in the early 70s, and that's why they had to revalue it a couple of times. Yeah, I mean, the first one, technically, technical analysis wise, we had a big move in gold at the beginning of the year. We topped at 3,500 in April, and I guess the market took a breather for over 4 months. And usually these consolidations, they end up, especially a bullish one, end up breaking back out towards the upside. The chance of it breaking down is like 1 in 4. So technically, it's just confirming the formation. Fundamentally, I guess it's related to all the turbulence in the world geopolitically, I would say, and the fact that BRICS are getting more and more united, especially after India kind of made up for now with China. That will accelerate de-dollarization, and also all the debt in the West, government debts, that's weighing on the bond market, and I think that's helping gold. And I also think the economies, not just in Europe and in the U.S., are slowing down. And the economy that slows down, that means less tax receipts, and that means more fiscal problems. So I think it's a combination of those things. Silver has kind of late in the last few weeks was leading gold. I think ever since we broke like 35, 36, that confirmed the breakout. Yeah, so I'm very bullish silver, even more than gold. That doesn't mean I'm going to sell my gold to buy silver, but just keep trying to buy both. Summit you had in, I think it was Tianjin in China for the Shanghai Cooperation Organization was like a big turning point because India attended and Modi attended for the first time in 7 years. And it looks like India, China, and Russia, the big countries in BRICS, are very united. And then you had this military parade commemorating the end of World War II in China. And Xi Jinping was really flexing his muscles there. So, yeah, and talking about a new order, Chinese order or BRICS order. So, yeah, that really, in my opinion, will accelerate de-dollarization even more because these countries, even though they're not going to get rid of all their treasuries right away, they're going to try to accumulate more and more gold because gold is the only neutral reserve asset, even though I think the yuan will be a very important currency for these countries. So that's what's going on, and it will be interesting to see how the U.S. Reacts to this, because it's a challenge to U.S. power, and hopefully it won't result in any conflict. Hopefully it will result in some kind of cooperation and more of a multipolar world. That's a good point about the British pound, because it was only in 1954 that the dollar took over the pound as the major reserve currency. And we saw recently Tavi Costa published this chart that gold reserves for foreign central banks have overtaken treasury reserves of foreign central banks. So it looks like we're in 1954, so to speak, for the U.S. What I see happening is continued devaluation of the dollar, especially versus gold. Unfortunately, a lot of dollars are going to come back to the States, and that's going to make things a lot more unaffordable for people. And that's why, and I think the Trump administration knows this, and Stephen Miron, he's been appointed as to a post in the Fed. His main theory is to devalue the dollar. So I think they are going for that. But at the same time, they're pushing for reindustrializing the U.S. As a way of maybe softening the blow, so that, yes, people are going to be hard up a bit more, but if they have new jobs, it will help. Whether if we have a hyperinflation or not, that's still up for debate, even though I think we're very close to it. It all depends, I think, as well, whether this talk of revaluation is, if they really come out and revalue gold, if they revalue it really high, then we could see the dollar really Well, because revaluing gold really high means the dollar becomes worth a lot less. So, yeah, in my view, either way, one needs to keep a hold of gold and hard assets because it's the only way to keep moving is to devalue because the debt is so huge. The unfunded liabilities are so huge. And yeah, that's the only way out, short of just defaulting. And defaulting, um, I think politicians prefer inflation to default because default means like a Great Depression. No one has anything. At least in high inflation, people can still buy things even though it's not that affordable, but at least there's currency going around. Yeah, I think that's what the world is waking up to. And that's why central banks around the world are accumulating so much gold. But it's not just the dollar. All the major fiat currencies have lost like 99%. I think it's only the Swiss franc that has lost like 92 or 93, which isn't great either, but in relative terms, it's a lot better. And I mean, even if you just go back 20 years, Elijah, it's like gone up 10 times, really, from it was, well, even more than 10 times because the low was 250 back in the early part of this century.
Gold's relentless climb is becoming a barometer of deep structural problems that policymakers can no longer disguise. The steady rise reflects the harsh reality of excessive debt, political interference in monetary policy, and a growing reliance on money creation as the only available tool. In contrast to Asia, where gold buying has become part of daily life, the West remains entrenched in a cycle of debt-fueled consumption, widening the gap in resilience. History offers perspective. Just as Wall Street once dismissed bold predictions about equity rallies in the 1980s, today's skepticism about $5,000 gold or triple-digit silver ignores the scale of forces driving the market. With deficits entrenched, global alliances shifting, and trust in the dollar deteriorating, precious metals are emerging from decades of suppression to reclaim their role as ultimate stores of value. Let's get back to the interview.
I know some of the people who have been strong advocates for gold, outside the people that are always, talking about gold going up, starting to use words that I haven't heard since the early 80s that were describing a lot of things that were happening in South America, calling us at the earliest stage of a banana republic. And where it happens in a banana republic is when whoever the political powers it be twist the arms of people in charge of the monetary end and force just huge, creation of money in hopes of, solving the major problems that are out there. And that's the concern of at least some and me when the president is becoming so influential and wants to start, in a sense, putting his own people in. I think we're in a danger zone here. And I think people recognize that. Listen, to know where we are in the world, and I want to get this in. I'm sorry, Jeremy, if I'm skipping out. This weekend in China, most people will go shopping for gold. The malls are just full of people, young and old, taking their money and buying gold. For those here in the US that still can go out, they're taking borrowed money to buy a lot of things they don't need. Gold has been a tremendous barometer that Wall Street doesn't tend to look at because it's kryptonite to them, because it normally shows the real facts of what's happening in financial assets. So I think the rally in gold, for no other reason, whether you're a bull on gold and mining stocks, what have you, is a key factor to be looking at. And the fact that it's just rising continuously and sharply here is clearly signaling that the US and some other areas in the world have some very difficult problems ahead. We were getting almost hourly social media views of Trump being with Musk, talking about how Doge was not only going to solve and get rid of the deficits, but also pay down the debt. Where did that all go? Instead, it's gone in the opposite direction. And what that is telling you is that it gets to a point where you just put on so much debt that the only choice that governments or who's ever in charge, Federal Reserve or wherever else it may be, can only print money, because the other choice of hardcore deflation, we went through a depression once in this country, and it's far worse than an inflationary crisis. So I just think that whatever replaces the Fed, if it's going to be replaced in some manner, led by someone different, taking different ideas and removing themselves. The only weapon that they will have at the end of the day is to print money. And that's another reason why gold is reacting this way, because people recognize that and they know at the end that's going to be extremely bullish, especially since where growth is still occurring in the world, mostly through Asia. Those folks, many of them are joining groups, particularly the BRICS, in order not to be involved with the United States or its currency. So this is also the terminal stage for the US dollar that has been talked about for decades, and people talked about it. We're in that now, and you will see whoever does become in charge, whether he's just or she is a figurehead for Trump or an independent person, that they're going to just cheapen the dollar and print money. And that is only bullish for gold. So when I entered in the dinosaur age in the early 1980s, when almost 2/3 of current financial advisors weren't even born or were in diapers, we had a person come out and say that the Dow was going to go to 3,600, and no one knew who he was at the time. His name was Robert Prechter Jr. He had a thing called the Elliott wave theory. And why he was viewed so crazy at the time was for 13 years, the Dow before that had just traded between 700 and 1,000. In fact, a very famous magazine ran a front page cover of the Business Week called Equities Are Dead. So people scoffed and laughed and said, listen, this 3,600, we can't get to 30. We can't even get above 1,000. Well, we all know it went a lot further over the years, past 36. That same mode is steel and gold for so many years, trading in a range. Okay, now finally went through 2,000, a number we talked about. 5,000 and 10,000 can happen. It's too much, and especially in the time frame some people are talking about. Well, that was the same kind of attitude they had back then. It doesn't mean it's going to happen, but just the fact that it's moved in the manner that it has doesn't mean that it can't keep going. Yeah, of course, there's going to be times when look what we just went through. This summer was a dream come true for me. I said, if we can go the whole summer and go sideways and let moving averages catch up and all, it's going to set the stage for $4,000 or $5,000 gold. And now we have it. So, yeah, very, very short term. You're a trader. I'm not a trader. I only need one hand to count all the people who ever made money trading. But I think if you're long term and you still invest over the years, I think the only cost for gold still is higher. I mean, if you want to say, is there anything PeterGrandich that's a gold bull doesn't want to see? Yeah. I wouldn't want you to call me up 6 months from now, God willing, and say, Pete, do you mind coming on and talking about $10,000 gold that we just hit? Because if we hit it that soon or in a relatively short period of time, what occurred in the world would be a lot worse than whatever we're talking about today. Until a few months ago, for my entire career, silver was always a second choice over gold. Yeah. But when it got below 30 this year, I took the time to really listen to a couple of very smart people. Not all these people that are always telling you silver is going to the moon. And they presented an fundamental argument that was second to none. And so I decided that silver now can be on the same breath as gold. And then I decided after I did purchase it that I could actually lead gold at times. So I think it has its best fundamental argument in the 41 years that I've been at it. And let's not forget, everybody's talking about the old hunt high of $50 and change. Well, based when that was made, we'd have to get to almost $200 to adjust for inflation. So my call last week for $100 silver price, I don't think it's out of the realm. It's merely just more of a double from here. So I think we can get to see a triple-digit silver price, and that would be probably a 5,000 or more gold price at the same time.
We are in the midst of a profound monetary transition. Precious metals are not simply reacting to headlines. They are signaling the end of an era where debt and fiat credibility could be stretched indefinitely. The steady accumulation of gold and silver by both central banks and individuals reflects a growing awareness that inflation, fiscal imbalances, and monetary overreach are not temporary disturbances, but long-term realities. The parallels to past turning points in financial history suggest that this rally is only the beginning of a much larger repricing. For savers and investors, the lesson is clear. Ignoring these signals could mean missing the most crucial wealth shift of a generation. That's it for today. Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.